Good morning, everyone. Thank you all for joining us. Good morning to those on the East Coast and potentially California, and obviously good evening to those who are joining us from Asia. Welcome to this webinar, which is on investing in infrastructure in developing Asia after COVID-19, navigating geopolitics to generate long-term value, growth, and returns. I'm Alexis Crow. I lead the geopolitical practice globally for PricewaterhouseCoopers, and I'm also a senior fellow at the Richman Center at Columbia Business School. Today's event is co-sponsored by the Richman Center for Business Law and Public Policy at Columbia University, the Center on Japanese Economy and Business at Columbia Business School, and also the Apex Study Center of Columbia University. The Richard Paul Richman Center for Business Law and Policy at Columbia University was established in 2011 and is a joint venture of Columbia's business and law schools. The Richman Center promotes evidence-based public policy and fosters dialogue on debate on emerging policy questions where business and markets intersect with law. The Center on Japanese Economy and Business, or CJEB, was established in 1986 under the direction of its chairman, Professor Hugh Patrick, and is led currently by its director, Professor David Weinstein. CJEB is a research organization widely recognized for its vigorous activities, international symposia, conferences and lectures held in New York City and Tokyo, which provide prominent speakers from the public and private sectors a forum for collaboration and reflection on Japan, the United States, and the global economy. The Apex Study Center, or ASC, was established in 1994 and is co-directed by the Dean Merritt Jano and Professor Hugh Patrick. The ASC works to enhance Columbia University's rich tradition of research, conferences, lecture programs, and teaching on the Asia-Pacific region by serving the focal point of study on issues of economic importance for the region. Today, I'm joined by an extremely distinguished panel. Firstly, Keiko Handa, who is adjunct professor at SIPA at Columbia University. Keiko also serves on the board of Mitsubishi UFJ Financial Group and AGC. In addition to that, she serves as adjunct professor at Hitotsubashi University and is a member of the UN Investment Management Committee. Until the end of October of last year, Keiko was the chief executive officer at the Multilateral Investment Guarantee Agency, known to some of you on the call today as MIGA, the political risk insurance and credit enhancement arm of the World Bank. Glenn Hughes is the head of Vietnam for the Logos Group. He joined Logos earlier this year to drive the establishment and growth of the platform for their infrastructure investing in Vietnam. He has over 28 years of experience spanning executive roles, project development management, and subject matter expertise for international development programs and property and infrastructure investments, working for both private and public sector entities in Southeast Asia, Australia, and the Middle East. Last but certainly not least, Samir Saran is the president of Observer Research Foundation, one of Asia's most influential think tanks. His research focuses on issues of global governance, climate change, energy policy, global development architecture, artificial intelligence, cybersecurity, internet governance, and India's foreign policy. He's also a member of the Global Future Council on Geopolitics for the World Economic Forum. So just a little bit of housekeeping notes. I know that we have a very rich and abundant audience represented today. We will be able to take Q&A for the last 30 minutes of the session, so in about an hour's time. And we will receive those in the Q&A box. So please do have your questions ready and enter them into the Q&A box, and we'll try to get to as many questions as we can. So with that, we will kick off. We were just actually sharing in the green room beforehand that I think this is actually kind of a bright spot in the global economy and the extraordinary geopolitical environment in which we find ourselves today, thinking about the potential for infrastructure investors and specifically Japan to be able to seed growth across developing Asia. And again, for many of the investors represented on the phone in a potentially distressed and dislocated moment. I think certainly when we look at the macroeconomic environment in Asia today, there are a lot of questions around challenges to the growth models, whether that be from trade and export vitality, whether or not that be from increasing services-oriented growth, and indeed for many of these economies that were hard hit by COVID, the ability to be able to rebound quickly and to regain productivity in terms of a workforce. So with that, we'll start with a little bit of unpacking the current macroeconomic environment in developing Asia today. We have a significant infrastructure gap, which entities such as the World Bank and the ADB have assessed. So Keiko, let me turn to you. Can you give us a snapshot of what is the gap? What do we need? And how might this be actually doubly impacted in the wake of COVID? And also to think about why Asia?
Alexis, thank you very much for having me. Good morning for the people from the North America, and also good evening. I see a lot of people also joining from the Asia too. It's my honor to be on this panel. First of all, thank you, Alexis. Let me start with how large that Asia is. Among the world's 7.7 billion population, over 2/3 are currently living in the developing parts of Asia. So this, and a lot of things probably changes with and after COVID-19, but demographics doesn't change so quickly. So therefore we have to understand, well, there's more than 2/3 of the people living in developing Asia. Then I think let's move to the approximate size of the infrastructure investment that we do and that we actually have to have in the future. According to McKinsey's study, this is a little bit of old, of 2017 study, they're saying about $2.5 trillion per year was spent in global infrastructure. And going forward, McKinsey's forecast, let me actually take another quote from the World Economic Forum, since Alexis as well as Samir are serving their committee. WEF estimated last year $15 trillion of investment is required between last year and 2040. So again, this is a big number. And going back to the McKinsey study, McKinsey forecasted, this is annual numbers, $3.3 trillion per year is required to fulfill the infrastructure demand between 2016 and 2030. And they have, by the way, breakdown number by region. In emerging Asia, including China, 41%, or the $1.4 trillion per year is required. It's actually supposed to be invested in infrastructure. If we believe China has financial capacity, so therefore we also need to look at ex-China emerging market Asia number, which is the $400 billion per year. Now, we don't really know exactly how much is the gap as of today, but one thing I can really say, gap is huge and a gap is widening. The reason is the following. Fiscal space in many countries, not only in developing countries, but also United States, many EU countries, UK, Japan, is getting narrower. You see, government have to step in to support people who are actually impacted so much from the COVID-19, so therefore less money is available. By the way, going back, where the money is funded to finance the infrastructure, there are two sources. One is ODA, Official Development Aid, or the tax money, and another bucket is the private investment. Up until 1994, ODA was larger for developing country. But after that, foreign direct investment surpassed the ODA. That's why how to mobilize private investors, especially in infrastructure, is extremely important. And I think it's getting more and more important right now. Then after the COVID-19, what's important in infrastructure? First of all, increasing needs of communication. So therefore, investment for the broadband, mobile communication is getting a lot more important. By the way, if we don't have a power, we cannot use internet. So therefore, we also need a power, stable power to it. So therefore, overall, I would say opportunity in Asia infrastructure is 4 points. More than 2/3 of global population lives in emerging or developing markets in Asia, and large, infra investment gap is out there. I think my best guess is more than $100 billion per year. And a third, needs for the broadband mold, which is more suited for the private investing, by the way. The reason is ultimate beneficiaries are willing to pay for it. This is different from the water. Ultimate beneficiary knows broadband, mobile communication is not free, so therefore willing to pay for it, and then they also prioritize the payments of those. And also ODA money is enough. Of course, there is a challenge. Governments has less and less fiscal space, and emerging market development markets has usually non-commercial risk or the commercial challenges. Some of them are perceived, some of them are real. I'm more than happy to talk later. And also the last part, a lot of people saying lack of investable project. Infrastructure really needs a lot of work. How much money that we have to kind of receive from the ultimate beneficiary, therefore, if it's not enough to cover the costs, how much money that we have to kind of obtain from the government, or possibly sovereign counter guarantee. And then those things requires a long time to prepare. So those are the challenges. Having said that, Alexis, I completely agree with you. There are good, interesting opportunities to support many people in Asia at the same time, also private enterprises, to earn the reasonable return. Thank you.
Thank you so much, Keiko-san. Glenn, I want to turn to you as the private investor and just pick up on one of these comments that Keiko made on just that shift of economic activity from the public to the private space in infrastructure specifically. So if we assess that we have this extraordinary gap, I think the ADB puts it in South Asia as 2.5 trillion per year, then in what ways does private sector capital come to be able to fulfill that need? And I think obviously we're sitting in a world in which, institutional pools of capital are paying governments in Europe to hold their money. And so obviously we're seeing this huge shift into alts and alternative investments. You've covered both sides of the fence. Can you just speak to a little bit about the opportunities that we see there and the impact on efficiency of the assets themselves?
Sure, and hi to everyone. Sorry for a late introduction. Alexis, everyone, I'm drawing a little bit on the past 4 or 5 years in Vietnam, both as a PwC advisor and more lately as an investor. But for sure, a place like Vietnam, like many other emerging countries in Asia, have used up as much of the ODA sort of sources as possible. And certainly Vietnam, if I use that as a touchstone case study, are at that point where they've now achieved significant poverty alleviation and off the back of ODA support and multilateral support, but recognizing now that they have to shift more of the burden or seek more co-investment with private sector. The challenge has been that shift of capabilities and shift of legal foundation for setting up public projects, public finance projects versus PPP frameworks, for instance. And it hasn't sort of helped that over this last 4 or 5 years, where a country like Vietnam has needed to embrace that transition. You've got stories coming out of developed markets where governments are questioning PPP models and the value for money and the ability of the public side of the equation to manage the risk. So there's there's a significant requirement to embrace PPP. A place like Vietnam is working very hard, even setting up a whole new PPP legal regime derived from its old investment laws and such, and working hard to present projects, but difficult still on the public side to present them as to find the resources on the public side to present projects in a reformed or a pooled way through formal tenders, and with confidence that the public sector can protect its interests in doing those transactions. So the willingness is there, and there have been big examples in Vietnam, for instance, of power projects done on PPP basis, port and transportation, highway, and mobile and telecom networks. So it is there. I guess it's not been fully unleashed, but I know, like other emerging markets, Vietnam is certainly looking to create more opportunity and to be more encouraging of private sector investment, particularly in its nation building infrastructures.
Thank you so much, Glenn. So when we think about the geopolitical environment, I'm going to turn to Samir, one maestro of geopolitics. I think what we've noticed is obviously a diversification of supply chain activity out of China. And this was not, this actually predated the Trump administration and a lot of the trade tensions, primarily due to a wage diaspora and higher wages actually trickling down across ASEAN countries and then to South Asia, giving a boost obviously to growth in countries such as Vietnam and India. So we had the wage diaspora, then we had the US-China trade war, which when we look at the data, clearly supply chain activity has been diversified rather than either shut down or wholly localized. And that we might say that some OEMs, manufacturers, whether they're from Japan, whether they're from the US, whether they're from Europe, are moving from a mentality in their supply chain resilience from just in time to just in case, and being able to have multiple nodes of production. Having said that, in the wake of COVID-19, we're hearing some policies being announced, whether it's in India for a self-sufficient India, from Modi, whether it's Biden talking about Buy American. So there is this, undercurrent, obviously, of populism that is shared on both sides of the party bench. Where do we stand, Samir, in terms of globalization? Is it over? Is it dead? And what are the implications for India's growth going forward?
Alexis, this is a good 1 hour discussion by itself, this question that you posed to me. But let me quickly, beg your indulgence and go back to something what Glenn and Keiko were engaging with, and let me try and answer your question through their interventions. What was really interesting was that all of us know for the longest time, multiple reports, 2017 report of IMF, you mentioned the World Economic Forum report, Keiko, you mentioned, we have read the UNEP report on sustainable financial systems. You can look at a number of reports and they will tell you similar stories, that emerging markets require $6 to $7 trillion of infrastructure investments on a yearly basis for the next few cycles to be able to meet their needs. And that's basically the broad brushstroke of need and opportunity. We also know through those reports that there are close to $150 billion of pension funds and insurance funds in rich countries, which are lazy money, which are negative yielding deposits. And many of them are going to be called very soon. And there are going to be rich countries having to bear the deficit in terms of what they've been able to earn through the money and what they need to pay to the pensioners. And on the other hand, you have these big infrastructure projects, which are opportunities to earn 8 to 9% on the same money if you were to invest it in these emerging markets to be able to pay your pensioners and to be able to live up to your insurance commitments. And yet the world never found bridges to do this. We were unable to build bridges between lazy money and opportunity in the emerging markets, because we had something called Basel, we had something called political risk, we had something called risk ratings. We created black box, we conjured black box mechanisms to prevent money to flow from low yield to high yield destinations. Now, interestingly, what the pandemic and what Donald Trump have done is that they have added a new meaning to the word political risk. And I think that's important. The pandemic has created a greater awareness of systemic risk that the financial system used to ignore. So the question now is the financial system, are the bankers going to sign the Paris Agreement? Are they going to understand that their value is going to be destroyed unless we can globally respond to climate change? And that means, are they willing to deposit to make some of the investments in the front line of the climate battle, which are the emerging markets? That's where the front line is. That's where the new infrastructure is being created. That's where either coal plants or solar plants are going to be built up. So are we willing to look at systemic risk beyond the geography risk or beyond the political risk that were the definitions earlier? And I think the pandemic is going to start this debate, and the pandemic is making people understand systemic risk far more acutely than before. Donald Trump has created the China risk. China offered you regulatory certainty. They offered you political stability. All Western capital loved going to China. Now China has the geopolitical uncertainty around it. And therefore, countries such as Bangladesh, such as India, such as Vietnam, and many others who were politically unstable, who did not have regulatory certainty, may become far more attractive. So I think the political risk and the decoupling or the trade wars that you mentioned, Alexis, are also implicating the flow of capital, like significantly. And I think in the next 5 years, you will see risk acquire a new meaning. Now, let's come back to the more specific question you have asked on just in case approach to supply chains. And I think that's important. You have hit the nail on the head. I was speaking to the head of the Apple business development in India just a while back. And I asked him, what are you doing with your production facilities in India? They have physically lifted plants out of China and moved them into India. And while the numbers may be a bit off the mark, but if I recall, Apple exports anything between 180 to $200 billion worth of equipment out of China. And they are looking at putting close to 30 to 40 billion of those exports into India. So like you mentioned, no one is closing the China option. Everyone is building alternates and alternatives to the China model. And in case some countries such as India are able to roll out the red carpet and create conditions conducive to business, you will see the longer term implication of this Trump movement. So while Trump may have ignited a certain discussion and may have created an American consensus, much to the chagrin of his detractors, I think there is going to be new geographies that will emerge in business decision making. Similarly, you will see close to $1 billion of investment by the smaller OEM and the supply chain partners of Apple from Taiwan. So Taiwanese companies are investing close to $900 million in India, and they're going to be supplying to Apple, which is building $30 billion worth of, in its eventual capacity, $30 billion worth of manufacturing out of India. So you will see a whole new geographical dispersion of supply chains taking place. I think the port cities that we think were important may no longer be that important. Certain port cities that you ignored may become new hubs. I think the geopolitics of the next 10 years is going to surprise us. For example, let me give you another instance of one very interesting investor coming into India. And that tells you what's happening in the geopolitical landscape. The world's largest energy hubs are beginning to invest into India. They are putting money into India's infrastructure fund that is creating sustainable and green infrastructure in India. They are putting money into India's technology companies. They are putting money into India's digital retail companies. Now, suddenly you see a post-fossil fuel alliance emerge in the Arabian Sea as well. So this is not only an ASEAN story or a Southeast Asia story, it is also happening in West Asia. Now that changes the nature of the Suez Canal. You know, the Suez Canal of the old is going to be replaced by a digital West Asia that is increasingly going to exert influence on the future of the fourth industrial revolution. So while the second and third were fueled by them in a different manner, the money they have earned in the previous two cycles is going to be deployed in the fourth industrial revolution. So you are beginning to see the Canadians, the Australians, the Japanese ignore some of the old dogmas and invest in hedging in a world which is quite messy. I don't think you're going to see decoupling which is clean. It's going to be messy geopolitics over the next decade. investors are going to hedge. And I think hedge is the word that is going to define the next 10 years. And countries are going to hedge, forget about just the banks.
Thank you so much, Samir. I do want to come back to that geopolitical perceived versus absolute risk, advanced versus developing economy point. But just to stay with a little bit on this, I think what we're looking at is if globalization is diversified, what we're saying, and duplicated and multiplied, then obviously this is not a long-term challenge to the growth models of developing Asia or other emerging market and developing economies. So just thinking about the current state of production in light of US-China tensions, especially playing out in the regions, and in light of the technological decoupling as well, and COVID-19, the shocks of supply and demand from COVID-19, I think what we're starting to see is a potential challenge to China's value-added trading status, according to which China acts as an aggregator of regional trade surpluses, gathering inputs from other countries such as Korea, such as Japan, and then channeling these out to become, final value-added products. I think certainly in the wake of COVID-19, obviously, notably, the government in Japan has earmarked $220 billion from its stimulus budget to be able to take $200 billion of that to onshore Japanese manufacturing activity back in Japan. I think so. Then, therefore, 200 million can go to other countries. So in this backdrop, I think what I'm noticing, Glenn, and I'd love to hear it from your perspective in Vietnam, is we are looking at if I'm going to manufacture, I'm going to stay close to my sales base, which means that for a lot of Japanese companies, they're going to maintain a base in mainland China. The same goes for US companies such as Apple. I think this is one of the justifications for Apple growing in India, just because of growing its sales base. Where do we stand on that? And then where do we stand in terms of Vietnam eventually becoming one of these value-added exporting countries?
Okay, so certainly Vietnam is alive to these shifts. We've obviously been feeling it for at least for the 5 years that I've been here. The steady movement of Japanese, Korean, and in a sense Chinese investment into manufacturing production into Vietnam. It's been happening. What's now being observed is, I guess, a big bang version of it. There are whole supply clusters, manufacturing clusters that are seeking a new home. So some of it, I think, isn't China plus. Some of it, there are elements of it that are ex-China, looking for a new home for their hub. And it's interesting to me to be in conversations where Vietnam is vying against host countries like Mexico, because where cost bases may be similar, but it is that access to market. So, but if we're talking about electronics and smaller devices, in a sense, be a little bit more agnostic about destination to market or distance to market, given most of it's air freighted. So it is interesting to me that Vietnam is certainly central geographically and access to markets equidistant across ASEAN, but also now being seen as a hub to be able to launch product for sale into the Northern Hemisphere, particularly this smaller smart product that Vietnam's positioning both with foreign, Samsung's been there producing electronics, phones and screens and others. There are others now coming into Vietnam. Vietnam is creating its own domestic manufacturers in the electronics sector, for instance, looking primarily to this 100 million domestic market and rapidly increasing use of mobiles and internet technology and leapfrogging old copper wire straight into digital and wireless age. So it is an intrigue to me that Vietnam is working hard to attract it. They realise the economic impact. They're probably a lot more savvy, though, like other emerging markets, about how they're going to capture technology transfer, knowledge transfer as part of the bargain of being able to offer up the incentives to host these new hubs and new clusters. And the trade distances seem to have dissolved when, particularly in certain product sectors that freighting piece isn't big bulky goods going into containers onto ships going for week-long hauls. They are short, just-in-time movement through air freight. So hopefully that comes close to catching some of your answer.
Thank you so much, Glenn. I do want to pick up on that point that Samir raised and turn to Keiko on this concept of absolute versus perceived risk. And I think clearly one of the reasons why I am employed is because of this rise of geopolitical risk in advanced economies today. And obviously people can't get their heads around some of the potential changes that have resulted in France, in the United States, or potentially in France, in the United States, in Italy, in the UK, most infamously perhaps. But so Keiko-san, when you have looked at working with different investors in terms of guaranteeing investments as part of MIGA, and you've addressed obviously investment in projects in democracies and non-democracies alike, what are some of the things that you look for, and what are some of the things that help to mitigate that risk of investing in a place like that Samir mentioned, the black box?
Thank you, Alexis. That's a very, very good question. Yes, some risks are real risk, some risk of perceived risk, obviously. Then I think what I was recommending is to slice that risk into several buckets. Then I think find a way to mitigate each of them. For example, overall risk associated with like infrastructure. First category I would call non-commercial political risk. I'll come back on that detail. Second buckets, now these days we call environmental social risk, including like COVID-19, possibly climate changes out there. Subcategory I would call foreign exchange fluctuation risk. Some currency are picked into the dollars, some of them are not, including like a tax reader and South African lands and so forth. I think, the fluctuation is out there. And the last one is the commercial risks, such as like new competitors comes out, or, some technological disruption happens, so your products are obsolete and stuff like that. This is happening. Then in terms of the first category of non-commercial risk or political risk, typical risk are four. First one is the breach of contract by the government. Second is the war and civil disturbance. I think something sometimes happens between India and Pakistan now. I think I saw that. I think something happens between India and China. I think this is it. Third is the currency incompatibility and transfer restriction. This one, even government has a very good will. And then I think project is going really well. Sometimes some country have less forex reserve that they really need. That's actually happened in Egypt about 4 or 5 years ago. They managed very well, they fixed it. But I think, we have to prepare for that. This essentially means you actually make a money from the project, but you take like more than a year to bring those money back to your home country. I think this happens. And then last one is expropriation. This expropriation related with the nationalism, and this happens sometimes in like a mining sector. A lot of people of the country do feel like, okay, this, let's say gold or copper is our asset. Why foreign companies making a lot of money out of it? Although foreign company had a contract signed and agreed with the government, so therefore it invested a lot of money to make a mine. But I think that's really happens. Also, there is obviously a chance like a power plant got expropriated. This didn't happen like recently, but it was happened like a long time ago. So those are the risks. Then I think I think when it comes to those political risk category, not only MIGA, but Asian Development Bank, NEXI, which is a Japanese agency, and also JBIC and so forth, can support to somewhat mitigate. Also, IFC can work on it too. But forex risk is probably one of the most difficult things to mitigate, and a commercial risk also private have to take about it. And then environmental social risk, I think it's has more attention these days. The reason is when you look at the World Economic Forum's global risk report, like last several years, #1 risk people raised is the climate risk. By the way, 2015, those communicable disease risk was #3. So it was warned, and we didn't really probably listen it carefree, but it's really happened. This is the situation. And if I may, when it comes to infrastructure, there is also, in addition to the ENS risk, there is a 3 or 4 more specific risks. First risk is, sometimes we really want to minimize the upfront investment. So therefore, that's causing a lot of problem during the operation. In other words, maintenance costs or repair costs getting higher. So therefore, we really need to look at the life cycle cost to it. And also safety is another one. How much to invest in a safety, so therefore we can secure the safety not only for the staff but also people in the community is a one. Another one is the some cost associated with the resilience against the natural disaster, and then last one is the people in the community somewhat will affect during the construction. They have a dust and so forth, and also potential like social unrest. Therefore, good infrastructure developer are strongly encouraged to invest in some kind of contribution to the local society and economy. I think those things also have to be considered. But again, I think the most important point, as you said, is slice the risk. Slice the risk into those specific category. Then I think forget about the passive risk, but a real risk we have to mitigate.
Thank you so much, Keiko-san. I think you've provided a lot of fruit for development banks and for governments in some of these countries to be able to think about some policy changes. I think notably on that Forex risk that you mentioned, the healthy development of foreign exchange reserves by a lot of EMDEs post-Asian flu, I think has been a really notable implementation of macroprudential measures. That exception of the Egypt dollar shortage a few years ago, I think is a notable example, but other countries such as Brazil. Brazil also notably, as we discussed before, your former colleague helping to set up some of those currency hedging programs, because obviously the US dollar or euro to Brazilian real risk is a key, I think, inhibiting factor for some pools of capital to be able to go to Brazil. But you've called it out, Samir brought it in, and I want to talk about the Jolly Green Giants. Obviously, when we think about infrastructure investing, actually, in a previous life, I worked in energy investing, and so, infrastructure includes, down, up, and middle stream oil and gas investing as well. But obviously, as you mentioned, there's a huge sea change, pun intended, with the climate risk that the most recent global risk report, I think, was very telling for the youngest, like 18 to 24 respondents, where the top 10 risks were associated with sea level change and sea level rise and climate change. So, Samir, I know you've worked obviously a lot on this, on the green agenda. We've worked on this together. I want to come to your thoughts on, there are some questions about the cost of developing wind and solar versus coal. And so there's this question on trade-off growth of whether or not, and Glenn, we've talked about this in Vietnam as well. You bring mouths out of poverty, or you more slowly develop a greener economic growth. I've heard that also within one specific Latin American country that was very resource rich as well. Samir, where do we stand? Is this feasible in the wake of COVID to be able to stimulate investment into wind and solar and also to clean tech?
Alexis, there are two dimensions to your question. The first is it economically viable? Is there a business case for renewables to compete with coal or the gas industries? And the answer is yes. I think in a recent bidding for power dispatch in India, the lowest cost was from a solar plant. And its price was more attractive than domestic coal plants. So I think India, through the sheer scale and size of its demand and consumption, has been able to bring down price points to a level which actually allows it to become a template for others around the world. Miraculously, we get technology and intellectual property from China and other parts of the world, but our assembled plants are cheaper than anywhere else in the world. So I think the ability to bring various parts together and produce renewable energy at such price points is possible. India is doing it, and I think it is India's growth opportunity. The challenge is going back to infrastructure finance, and I think that doesn't change. The reality is that India invested 135 billion last year on infrastructure. This is last year, 2019, which is possibly half the amount we need to invest every year if India has to invest $1 trillion every 4.5 years for the next 4 cycles. While we invested 135 billion, 70% of all infrastructure finance was public finance. It came from the central and state governments. In the post-corona world, the governments will not have fiscal space. Like your article, your essay, Alexis, that I had the privilege of co-authoring with you, mentions that governments are stressed to respond to the development implications of the pandemic. They don't have the same fiscal space to divert large chunks of money that infrastructure finance demands. And much of this infrastructure finance is going to be green in the future. And the bottleneck does not change just because the color changes. So that's one part of it. The second is the political messaging around choosing renewables and solar and gas over coal. Coal industries, mining industries, and certain other emitting sectors have been politically sellable to large constituencies of people, because there is a misconception that they create jobs, they create local wealth, they create benefits for the provinces that they are located in, which is not true, by the way. I have been in the old economy as well, and I know mining plants require less than 10 people to manage huge chunks of operations. So I think the political message needs to be fine-tuned and rearranged so that the economics that is beginning to work can be extended. The challenge is something else, Alexis. Since emerging markets will not have the fiscal space to deploy huge chunks of money into infrastructure, they will need to mobilize global finance. Now, here is the sad story of climate finance. Nearly 80% of all climate finance remains in the country of origin. Climate finance is not leaving the borders. Countries are not necessarily walking the talk when it comes to banking green projects. They are willing to sell technology, they are willing to sell intellectual property, but their money does not follow their intent. And I think that is the biggest problem. And I have always maintained that there was one notable absentee in the Paris Agreement. No, it's not America which backed out, it's the bankers who did not sign it. I think bankers need to sign the Paris Agreement because global capital has to be deployed in emerging markets if we need to ramp up investments into green energy and create that front line for responding to climate mitigation. Let me tell you, in emerging markets, you are spending 1/3 more just because of higher financial costs to set up a renewable plant of a similar capacity. And I think that is criminal. I think any prudential system, any regulatory system that makes climate battle 1/3, 33% costlier is stupid. And I think the pandemic should make us aware that the risk climate poses is going to be multiple times what this pandemic has done. And we must take this more seriously. We must create a new architecture in Glasgow next year at the COP26, which funds the solar ambitions of countries like India and many countries in Africa, which funds green transitions of cities, which funds EV and new mobility mechanisms, that creates investments in R&D around storage. Because unless storage comes into play, you will continue to see renewables, solar and wind both play at the margins. I think solar storage is going to be the game changer, and we need to make that happen for the emerging markets to fully utilize the potential the economics are already beginning to offer. So a business case exists. India has shown that. Many other countries have also done the same. And I think now we need the political messaging and the right investments in the right kind of scientific areas to create sustainable renewable systems. Sorry if I was a long-winded reply to a very specific question.
Thank you so much. You raised this critical point around finance and sustainable finance. And I think one thing to note, you called it lazy capital. I might call it unadventurous capital, but there is certainly a distinction here between sticky versus patient. Yeah. And so by sticky and patient, versus fickle. So by fickle, I mean, obviously public markets, liquid markets, equities and fixed income, which can, as Mark Carney and his team have shown at the Bank of England, which can result in huge vulnerabilities and shocks within emerging market economies, resulting in currency depreciation, et cetera, the likes of which we saw during the taper tantrum. Versus that patient long-term capital that Glenn represents, that some of the bodies that Keiko-san has worked with represent the pension funds, again, that need to be mobilized. Those pools of capital also, I think, that are domestic pension funds that absolutely will not invest in developing Asia, which is probably one of the reasons why we're doing this webinar today. There are some innovations to move that sustainable finance activity into the real economy. I think Keiko-san, the Regio bond, piloted at the World Bank to be able to channel in some of these funds into real economy sectors, I think in the wake of COVID-19 has been positive. Could we just get your thoughts as well on the discernible shift that we're having within some of the multilateral development banks? Some are still making up their minds as to whether or not they allow for coal financing abroad. You tweeted recently about some groups getting kicked out of the UN Sustainable Development Goals, and I just wanted to know, can you give us a little bit of an insight as to how real this is and how much traction it's gaining?
Okay, well, thank you very much for a very interesting question. Scientists telling us we have to limit the global warmer, temperatures goes up less than a 1.5 centigrade. The question is, how do you get there? And let up to be large portion of greenhouse gas emission is coming from the power generation. Then power generations, GHG emission is different from what kind of source to coming from. Then three scientists, not me, scientists telling us coal-fired power plants average emit more GHG than the gas-fired. So therefore, Trace World Bank Group decided not to support coal-fired power plants, except for very exceptional cases, I think more than 10 years ago. So that has been implemented. And several different development banks have several different rules to it. That's where we are right now. But going back to the Samuel's point of we have to leverage more private, which I agree. I think everybody agree. G20, UN, this one, everybody agree. A lot of people have different opinion, but when it comes to we have to leverage more private investment into the infrastructure, everybody agrees. But I think there are small issues, especially navigating into renewable. The first issue is private, their money is not their own money. Asset management company have somebody to support pension funds. Money is essentially, every of our money. So therefore they have to be responsible investors to generate decent risk-adjusted return. Let's say they want to look at the renewable power project somewhere in Asia. And then typically investors generate the power. Then some power company distribute and collect the money and pay back to the investors. But a lot of power SOEs, state-owned, most of the power company in those countries are state-owned enterprises, not the private company. But those power SOEs, fiscal situation is quite tough. All of us wants to have a cheap power. So therefore, politicians try to manage the level of the power charge tariff. Therefore, the balance sheet of power SOEs are quite tough. That's why private investors select some of them or ask guarantee from sovereign or municipalities. India's case, some of the states' financial situation is good, some of them are not necessarily good. So therefore, some of the states will not necessarily have a strong financial states. They actually, private investors, even wants to go to the sovereign guarantee from the Indian government itself, and Indian government is not necessarily very, very happy to extend that sovereign guarantee of those. That situation is going on. So I think that's probably one of the biggest problem right now. When you think the reason I mentioned telecommunication or broadband is more suited, we don't really have much that problem because ultimate beneficiary are paying the market rates to cover the costs. That's I think where we are right now.
Thank you so much. I think this cost issue, I've been looking into renewable energy investing in domestic Japan, and I think obviously that cost issue is a prevalent one there. Last question, I'm turning to Glenn before we head to our audience for questions, so please do prepare them in the Q&A box. Glenn, as a private investor, as Keiko-san has highlighted, you are responsible for people, and primarily you're responsible for generating returns and long-term value. So in the wake of COVID, you and I have discussed this, how are the typical types of infrastructure investment targets changing? I mean, classically, there's one notable infrastructure fund here that raised basically a fund overnight to be able to invest in developing Asia. And some of their classic targets that have brought in a lot of the largest pools of capital are in toll roads or airports. How might the infrastructure assets themselves be changing in the wake of COVID? And is that a pro bono kind of a spin, or does it actually have real return potential?
So I think the answer is a little bit bundled up in an observation that Keiko-san shared. I mean, the old regulated assets, the backbone infrastructures of roads, airports, seaports, rail lines, power stations, it has been increasingly difficult for both private, particularly in, say, a Vietnam context where the government is trying to prepare, but they are wary of those contingent liabilities that will sit in there where the international finance, typically the first question is, where's my guarantee? Because of all these maybe unknowns, or, and I don't want to be too critical, but, thinking about risks in a reasonably broad way and just saying, can you just cover all? So there will be difficulties in finding those opportunities and getting those opportunities activated, particularly as Samir also has acknowledged that, the fiscal constraints that are additionally burdening. So I think it is going to be those direct-to-consumer sort of telecom style of services, or in my case, specifically infrastructure geared around, private infrastructure geared around improvements in the freight and distribution networks that sort of cut across the transportation infrastructure investments, but don't get typically caught up in regulated tariffs or regulated pricing that a power utility or a water utility or even toll roads might do, where you're trying to serve relatively poor communities in emerging countries. So where telecoms come through and you're able to get consumers paying directly for the service, and where, for me, trying to improve freight and logistics assets, where I'll have tenants and other service providers paying me a tariff. I noticed Samir with a hand up. Jump in.
No, go on. I'll come after you. I'll make a quick point after you.
Okay. So I think maybe some of the classic sort of longer term stable income infrastructure choices, where there are regulated assets, regulated tariffs, regulated returns, but secure in a sense. The ability to bank those, so to speak, in emerging markets will be increasingly difficult. But that infrastructure still is required. But maybe during this period of sort of resetting, if we can call it that, it might be other sort of priority infrastructures that will come through. Hopefully off the back of shifts to renewables, for instance, in power, as Keiko said. you need the power to get the networks working, the mobile networks, et cetera, that then fuels e-commerce and a few other things. But they will be the new infrastructure targets, I suspect, particularly over this next near term, as the world starts to readjust to where they're going to find returns and what sectors are sort of available.
Alexis, if I could just jump in very quickly, I think this is a very important point for emerging markets and their infrastructure ambitions. If you look at India in the previous year, 2019, we received private investment commitments totaling $7.6 billion. And of course, we received much larger amounts for our tech sector, etc. But you would find that out of the $7.6 billion, 88% are in the road sector. And this is, and I think this is an important and telling point. People are willing to finance roads because you can recover immediately through tolls. And there is a system that allows assurance of recovery. The other infrastructure sectors like power and energy suffer from a reason which is their use as states for dispersing social protection and also distributing government government benefits to individuals. We subsidize electricity, we subsidize water consumption, we provide subsidies through our grids. Unless emerging markets can reclaim the grids and provide direct benefits to the customers rather than through the grid itself, infrastructure projects around energy will be unviable. So I think reclaiming the grid is an important facet that we must think about if we need to grow the energy sector. And more importantly, we need to think about some clever bundling. I think we need to now think about asking the World Bank and other private investors to fund road projects with renewable energy projects. I think they have to be bundled into infrastructure classes where the risk is offset by a certain lucrative sector vis-a-vis a more regulated sector. So I think it's important for domestic reforms at this stage if we are to fully exploit a new mood to invest in infrastructure.
Thank you so much, Samir. We have some fantastic questions coming through. In fact, two of our participants have cited a similar question. And could best be summed up by lazy money seems to be an important piece of the capital stack for infrastructure investment. What are the key hurdles, maybe the top three, to get these investors on board? Is it PE funds innovating finance or governments acting as an anchor? So Keiko-san, let me turn to you first, please, on that.
Wow, this is like $1 billion question. Thank you very much.
Or trillion.
Yeah, maybe trillion. But let's go by sector by sector. Telecommunication, I did not really see that much problem. I think only the issue typically I'm hearing is, how much government should take to giving a license to the mobile operator. But again, I think ultimate beneficiaries are willing to cover the cost or pay for it. Then not that much problem. That's one. And the load sector, Samir, yes. Overall, usually okay, however, not necessarily all the time. I think I see a lot of issues in load project in Latin America and Africa and so forth. I didn't hear much in Asia, but it's not 100% perfect. But I think it's relatively better. And the next difficult category is the power, and the water is the probably most difficult category. I think water and power, as Samir, you mentioned, I think government reform is absolutely necessary. The tariff subsidy of the power and the water is very important for the election. I know that. Having said that, I think we need to fix it. And then I think, of course, some of the people can afford the payment of the tariff, they should pay. And some of the people are not. I think, government can think about several different ways to solve it. I think that's probably the biggest problem. Then I think another kind of layer of the problem that I see from the private investor side is the expertise and experience. Project preparation of the infrastructure is very complicated. Discussion of the tariff, we also need to think about long-term planning, not only the initial upfront of the construction time, but how to operate, how to repair, and then how to, if it's the case, if it's build transfer program, you also need to think about how to transfer. And those things requires a lot of experience. And at least I would say some of the investors, at least in equity investor side, should have some experience from the investment up until like exit. That typically takes 15 to 25 years. So therefore, there are not that many people can jump in. But I think there is one relatively quick solution is, if a project is more difficult during the construction phase, if it start operating after 2, 3, 4 years, start to generating relatively steady cash flow, then we see the country probably not going to have a drastic change at the time of the administration change. Some of the lenders kind of sticking to the loan, or some of the even equity investors sticking to the project. But I think I would encourage them to exit and then give it to the little bit of less experienced equity investors as well as lenders. So therefore, those experienced one can go to the another, brew project. That's what I think, but I'm pretty sure like a Samir and Gren as an investor, you may have a different idea.
Glenn, I'm going to turn to you on that one as well. Obviously, if we were to do a little bit of a role play, part of your role in mobilizing private capital is to convince some of these pools to be able to come into countries that may or may not be democracies that we outlined, or where there are questions around the growth model. So what are some of your tips and tricks for being able to mobilize that pool of capital?
Obviously, you're in a context, sifting through, if you like, emerging markets. There's various emerging markets and more emerging markets, I guess. A place like Vietnam, where it's now got 45 years of reunified history. It's got 25 to 30 years of evolution in opening market economy, but a state-planned sort of history, if you like, and in practice. So a place like here, its fundamental attraction is the certainty, or the relative certainty, of the state-planned economy, all the remnants of it, where we do know what the power plants are intended to be, the transport plants, et cetera, et cetera. So there is a level of certainty as to the government's intentions and objectives and policies around to support the investment and to support those infrastructures. So some of that context, let alone the economic growth and the potential returns, but then having to bring in everything that Keiko laid out at the front as slicing and dicing the risks, and Forex and others obviously being key to it. What I'm intrigued with is what are going to be the new targets. Is infrastructure money, even lazy capital, so-called, looking for the more patient, longer term, maybe lower risk, lower return, but still solid relative to money in the bank? What are the new infrastructure? Are we going to continue to pursue these big bundled power projects or the road projects? Touching what Samir just said, distributed infrastructure, claiming back the grid, rooftop solar packaged up in certain ways, connected with technologies to do with telecommunications and others. Are there going to be new ways that, in more bite-sized chunks, that the infrastructure investors are going to be able to get into, be able to mobilize enough finance and equity to pursue? I think most countries, Vietnam included, if you did the stats about the millions of homes and premises in the country, if you put solar panels and distributed generation to each of the households, you give up or can forego some of those big baseload investments, and that would have knock-on effects to the freedoms of the households to then consume more or spend more on other aspects of their life, maybe paying more for water tariffs, etc., etc. So there could be, not only looking for those big old fundamentals of economy and population and growth and reform and stability of government and predictability of policy, but what are going to be the new sub-sectors or sub-infrastructure, the novel combos of infrastructure investment that some capital will be adventurous enough to punch into. And I know as soon as they can enter an emerging market and they find a way to get in there, and for us, it's typically through logistics property or freight logistics infrastructure, there will always then be a familiarity to build up to launch further into other investment spend. So we have to be able to frame up what the context is to attract that capital and, in a sense, give it a safe landing to start with at a scale that is palatable. But then what is the scalability of it once you're here? And is it old school infrastructure, or are there more novel, more nimble sort of components or aspects of infrastructure that capital can pursue before they launch into bigger platforms or bigger investments?
Thank you so much. Samir, do you want to come in? Two short points. First of all, I think I agree with Keiko and Glenn both. But let me just add two things. I think, and I say it with all seriousness, I think the single biggest challenge today in our ability to finance infrastructure in emerging markets is the capacities that exist in the private sector. I think we need capacity building. In fact, I told the European Union, don't do capacity building projects in Asia and Africa, do capacity building projects in the rich financial institutions in Europe. I think they don't understand how to evaluate risk in our geographies. They don't understand how to evaluate renewable energy risks. They don't know how to evaluate technology risks. They are at sea. They are looking at the world through the 20th century practices. They need to be upgraded. You are struggling to change the world because you don't have human capital that understands the new world. So I think the single biggest challenge is the lack of talent that exists today in rich countries and rich companies that can make the right decisions. That's the first point I want to make, and take it with seriousness. I mean it. Since you have the money, deploy it. I keep telling people, don't give the $100 billion to us. Give it to your own companies so that they can upgrade themselves and invest and make commercial decisions which are more sensible in the 21st century. That should be your climate commitment. Give money to your own companies. Don't give it to us. And second, I think, and it's equally important, we need to rethink how we price, how we innovate in terms of financing long-term projects in a world which suffers from very short attention spans. People don't understand, psychology changes. No one is now going to invest in a 20-year return on equity coal plant. That's not going to happen. I think in the world where you want instant nirvana, you have to start thinking about finance that responds to that as well. So I think our financial innovation is not keeping pace with human evolution and with technology changes. I think therefore, to create patient capital, we will have to create relay races. We'll have to have a relay race of multiple actors contributing to different stages of the long project. We will have to have a kind of investor that comes in and covers Keiko's risk during construction. Perhaps they will partner with the MIGA so that they are de-risked. We will have a second investor coming in for the first 5 years where you are front-loading the debt recovery. You will have a utility type investor coming in the last stages of the plant where he is happy with the 5 to 6% return on equity. So I think we'll have to create a relay race of financial investors that can cover long-term capital in a world where human attention span is barely 30 seconds, and sitting in a 1.5 hour long conference seems like a wedding ceremony, Indian wedding ceremony. So Alexis, I hope that answered your question.
Thank you so much. You do raise a very, very powerful and also humbling point about human capital, that here we are sitting in our ivory tower high horses talking about the productivity and human capital in emerging market and developing economies. But of course, we have to develop this capacity within our institutions. I think, Keiko-san, you hinted at that as well, just that personnel capacity. And crucially, when we look at the types of capabilities that are required, I am quite buoyant on this as an economist because those are capabilities that can't be automated. In other words, you can model out an infrastructure project, finance, look at the potential for blended finance, etc. But that judgment capacity, the creativity, the agility, I think, and the human relationships that such a relay race would rely upon can be automated. Thank you all so much for joining us for this fantastic and very scintillating webinar on investing in developing Asia and infrastructure. I want to thank our distinguished panelists, Keiko Honda and Glenn Hughes, as well as Samir Saran. A recording of this will be up on the Columbia website and also distributed. And we really look forward to being able to continue to tackle these issues and again, to be able to identify opportunities around the globe. So thank you all again for joining us.